Let's practice preparation of cash basis and accrual basis income statement. Before we start, subscribe to our channel for more videos. Let's start with some initial financial data. In this example, the company has been maintaining its financial records using the cash basis of accounting. Financial data will be given for a 3-year period, from 2020 to 2022.
Here we can see the company's cash inflows and outflows over the 3 years. The top section shows cash receipts from sales. The bottom section shows cash payments for expenses. We can see that some expenses were paid in advance. For instance, $55,000 was paid in 2020 for 2021 expenses, and $40,000 in 2021 for 2022 expenses. These prepayments are highlighted with arrows below the table. This breakdown helps us clearly distinguish when cash was received or paid.
The task is to prepare for the years 2020 and 2021 cash basis income statement and accrual basis income statement.
Let's start with cash basis accounting. Under this method, revenues are recorded only when cash is received, and expenses are recorded only when cash is paid. In other words, the timing of transactions is entirely based on actual cash flow.
Let's begin with the cash basis income statement. Under this method, sales are recognized when cash is received, not when the goods or services are delivered. In other words, sales equals cash inflow. Here we can see how sales are calculated under the cash basis. We include into sales only cash, which was received during that particular year. We are not taking into the annual sales cash, received in later years. This clearly shows that under cash basis accounting, sales figures reflect actual cash collected, regardless of when the sales were originally made. Next, let's look at expenses in the cash basis income statement. Under the cash basis, expenses are recognized when cash is paid, not when the expense is actually incurred. So, simply put, expenses equals cash outflow. Here we can see how expenses are calculated under the cash basis. Only amounts actually paid during the year are included into expenses for that year. Earlier or later payments made within other years are not included into the current year expenses. This clearly illustrates that under the cash basis, expenses reflect the actual cash outflows, including prepayments for future periods. Finally, under the cash basis income statement, net income is calculated in a simple way. It's just sales minus expenses. Or in other words, cash inflows minus cash outflows. Here's the cash basis income statement for 2020 and 2021. This calculation follows the simple formula. Net income equals sales minus expenses. It is based entirely on cash inflows and outflows during the year, reflecting actual money received and paid, without considering receivables or payables.
Now, let's look at accrual basis accounting. Under this method, revenues are recorded when they are earned, and expenses are recorded when they are incurred, regardless of when the cash is actually received or paid. When the accrual basis is applied, sales are recognized when they are earned, not when the cash is received. This means that as soon as the company delivers goods or provides services, the revenue is recorded, even if the customer hasn't paid yet. In short, sales equals earned revenue. Here we can see how sales are recognized under the accrual basis. Instead of focusing on when cash is received, we look at when revenue is earned. In 2020, the company earned a total of $485,000. This amount includes all sales related to the year 2020 from the cash inflows table. cash receipt moment does not matter here. In 2021, the company earned $530,000. This amount includes all sales related to the year 2021 from the cash inflows table. Cash receipt moment does not matter here. These amounts are based on the timing of the actual sales, not on the cash collections. This approach ensures that revenues are matched to the correct accounting period, giving a more accurate picture of the company's performance. Under the accrual basis income statement, expenses are recognized when they are incurred, not when they are paid. This means that if an expense relates to the current period, it's recorded in that period, even if the cash will be paid later. In short, expenses equals incurred, ensuring that costs are matched to the period in which they actually happen. Here we can see how expenses are recognized under the accrual basis. Expenses for the year 2020 amount to $315,000. They include all payments of expenses from the cash outflow table for that particular year, since they are all related to the year 2020. Important to note that $55,000 prepayment made in 2020 for the year 2021 is not included into the expenses for 2020. Expenses for the year 2021 amount to $320,000. They include all payments of expenses from the cash outflow table for that particular year, since they are all related to the year 2021. Important to note that $40,000 prepayment made in 2021 for the year 2022 is not included into the expenses for 2021. This amount must be excluded from the year when it was paid and assigned to the correct period. Finally, under the accrual basis income statement, net income is calculated using the same basic formula: sales minus expenses. The key difference is that both sales and expenses are based on when they're earned and incurred, not on cash flow. This gives a more accurate reflection of the company's true financial performance during the period. Here we calculate net income under the accrual basis. In 2020, sales earned were $485,000, and expenses incurred were $315,000, resulting in a net income of $170,000. In 2021, sales earned increased to $530,000, with expenses of $320,000, giving a net income of $210,000. These figures reflect the company's true performance, because both revenues and expenses are matched to the periods they relate to, not when cash changes hands.
Finally, let's compare cash basis and accrual basis income statements. Under the cash basis at the top, net income depends entirely on cash inflows and outflows. Under the accrual basis at the bottom, revenues and expenses are recorded when they're earned and incurred. This shows how accrual accounting gives a more accurate picture of financial performance by matching income and expenses to the correct periods, rather than just recording cash movements.
Thank you for watching. Subscribe to our channel not to miss new videos.